European Central Bank President Mario Draghi says he's ready to pump more liquidity into Europe's financial system. I'm joined now by Jasper Lawler, a market analyst at CMC Markets in London. And Jasper, the dovish remarks from Draghi continue.
Hi, Scott. Very much more of the same. And I think that was probably the key takeaway here was that he didn't backtrack. He confirmed all the same things that were said close to the last monetary policy meeting. And so that sort of suggests that we're still on for some form of easing in December.
Well, of course, and he also said in his remarks today that the ECB would examine the degree of monetary policy accommodation during the ECB's December meeting. So is that what he's doing here? Is he prepping the markets for an announcement of more QE? Is that how we should be, interpreting this when it comes to the December meeting?
I think so. One of the things he also said was that just due to some of the headwinds that they see, namely around global growth, the path to normalization of interest rates looks like it's going to take a little bit longer than they first imagined when they began the policy in March. So that would suggest that if they think it's going to take longer, they actually may need to adjust the size of the program to do that. And so that would point to more quantitative easing. The other option is that he could obviously cut the deposit rate. That was something that was hinted at the ECB meeting. That would in turn, by dropping the deposit rate, would allow them to buy more short-term bonds in Europe, which are already yielding negative, anything below 0.2%. At the moment, they can't buy anything yielding that. So just dropping the deposit rate would in itself facilitate easier buying, if not more buying.
Now, the ECB's December meeting would be just over a week before the Federal Reserve's all-important December meeting, when, of course, the markets are pricing in a rate hike. So how should investors grapple with both of these events?
Well, it's just fascinating that both key changes in policy could be happening in the same month, and it really just massively highlights the policy divergence between the US and Europe. And so I think it goes a long way to explain why we are back down at 1.7 in euro-dollar. Euro sterling just hit 3-month lows around these comments. Just goes to show the sort of weakness in the euro that we're facing here. If Mr. Draghi is going to backtrack, he needs to do it fairly soon. If they are not intending to do any kind of policy framework update in December, because, like you said, the Fed is going after them. So they need to step in first and prepare the market, because otherwise there would be a massive disappointment, I think, and perhaps some readjustment in that euro-dollar rate.
All right. Now, Draghi also said inflation is, quote, somewhat weak and, of course, strengthening the case for more stimulus.
That's the main catalyst here. And when they first started talking about introducing more quantitative easing or extra stimulus, it was when inflation, the headline rate of inflation in the Eurozone dipped into negative territory. And I think while it's in that 0 to negative zone, the Eurozone CPI, then I think we would probably expect more action from them in December. Should we pull out of that a bit, then perhaps, especially with the Fed intending to hike rates,
right,
and to some extent Janet Yellen doing a lot of Mario Draghi's job for him by strengthening the dollar with a rate hike, maybe higher inflation plus that, a rate hike from the Fed together may mean that they actually don't have to do anything. So that CPI figure, I think, will be key.
All right, Jasper, we'll be watching. Jasper Lawler from CMC Markets in London. Thanks very much for joining us. I'm Scott Gamm, and you're watching The Street.